Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today's Friday, October 28th. And today's video is going to be brief, as next Tuesday I expect to release our monthly market monologue where I'll go into much more detail. In particular, on Tuesday, we'll talk about the GDP report from the third quarter that was just released. I'll give you a preview now. It was positive, so that's good news. Today I want to talk about two main things. One is this advanced decline line, which is on the screen now. I'll talk a little bit about that. And then I want to make sure that we're highlighting the bracket changes that the IRS just announced, as well as what that means for Social Security recipients. On the screen right now, we have the advanced decline line in the top pane. In the bottom pane, we have the S&P 500. Remember, the S&P 500 is indeed a broad measure of the United States stock market, but it is only 500 stocks. It does have 11 different sectors, so it is a fairly broad measure, but it's only 500 stocks. The advanced decline line, however, what I'm showing on the screen is the advanced decline line for all of the stocks that are traded on the New York Stock Exchange. So, what is the advanced decline line? Quite simply, it is the sum total of all of the advancing stocks minus the number of stocks that are declining. This is what we refer to as a breadth measure. One of the things we want to look at as market technician and money managers is how healthy is a stock market advance. And last year, you might recall that we talked about the bearish divergence that we saw in this advanced decline line. And so we showed you at that time, that the S&P 500 was still going up while the advanced decline line was going down. What that was telling us is that yes, the S&P 500 is indeed going up, but there are more stocks going down than are going up. And the analogy that we frequently use here is generals and soldiers. So the generals in this analogy is always the big stocks, the Apples, the Microsofts, the Googles, Amazon, etc. The really big stocks that make up the S&P 500. Because remember, the S&P 500 is cap weighted. What that means is the biggest stocks or the biggest companies in the S&P 500 have the biggest weighting on how that index is measured. So what was happening in the tail end of last year is the S&P 500 was advancing, but the advanced decline line was going down. And what that was telling us is we had more stocks declining than we had advancing. Because the S&P 500 was going up, what that really told us is the big boys, the big companies, the ones that I just mentioned, those stocks were still going up while more and more and more and more stocks were going down. Eventually, we saw these two lines converged. And about the beginning of the year, the advanced decline line was still going down, but then the S&P 500 finally started to go down when those big boys finally started to crack. So that's why we look at this. We're looking at this to see bullish or bearish divergences. The tail end of last year was an example of a bearish divergence. Now, let's flip to the right side of the screen. So changing our view to what's been happening lately, and we're beginning to see what looks like it could be a bullish divergence. So on the right-hand side, we see October 25th is right here, and the S&P 500 has started to come down, okay? What's happening on the advanced decline line, starting on that same date, it's still going up. What that's telling us is that there are more stocks advancing than are declining. Even though the S&P 500 is going down, there are more stocks that are advancing on the New York Stock Exchange than are declining over the last several days. Now, it's still too early to tell, but this is the beginnings of, I would consider, a bullish divergence. So this is good news. We'll see how this trade transpires by the end of the day, but this is a little bit of good news. Now, let's wrap up and talk a little bit about the changes that the IRS has made to brackets. And what does this mean for those who are already receiving Social Security retirement benefits? Well, recently the Internal Revenue Service announced updated brackets and deductions as a result of the inflationary adjustments that they have been making every year since 1981. Unfortunately, while that's good news for most Americans, unfortunately, if you're on Social Security, the level at which your Social Security benefits get taxed, that is not changing. So that's actually not very good news for Social Security recipients. Finally, today I thought I would mention some news out of Great Britain, especially if you are interested in Bitcoin and other crypto assets. Recently, Great Britain has proposed the regulation of all crypto assets. So we'll see where that goes, but it is certainly an interesting development. That said, thank you so much for watching. If you have any questions, by all means, feel free to reach out to either me or my team. Again, we have an office in Cary and Southern Pines, North Carolina. Naturally, in today's digital world, we do meet with clients all over the country. So if you have any questions, by all means, feel free to reach out. And we certainly hope you will remember to subscribe to our channel. And we'll see you again on Tuesday for our monthly market monologue. Thanks for watching.